While legendary investor Warren Buffett and Bridgewater Associates founder Ray Dalio tweak their portfolios to combat high inflation, contrarian investor Cathie Wood has been going against the trends and believes we are about to witness a deflationary crash. Hello everyone and welcome back to the Finance Guardian channel. In this video, we'll delve into the reasons why Cathie believes a deflationary crash is coming and how data supports her claims. Cathie Wood is a lonely apostate on the topic of consumer prices. The Ark Invest CEO, who is an enthusiast for disruptive technology, firmly believes that deflation is on the horizon. This puts her at odds with most of Wall Street. By the time Wood founded Ark Invest in 2014, she already had 40 years of experience researching and investing in innovation. Since Cathie has decades of experience to support her claims, we must look beyond any preconceived notions and listen to what she has to say. The November CPI came in at 6.8%, which caused fear among some investors that inflation has persisted, but not for Cathie Wood. The outspoken manager of the $21 billion Ark Innovation ETF said in a series of tweets that technology, including artificial intelligence, would lead to deflation over time. Now we believe that three sources of deflation will overcome the supply chain-induced inflation that is wreaking havoc on the global economy. Two sources are secular or long-term, and one is cyclical. Technologically enabled innovation is deflationary and the most potent source, wrote Wood, whose flagship fund surged 152% in 2020, but dropped more than 5% in October of 2021. According to her, AI training costs were declining between 40 and 70% annually, and that this could be regarded as a record-breaking deflationary force because AI will likely transform all sectors over the next decade. When costs and prices decline, velocity and disinflation, if not deflation, follow. If consumers and businesses believe that prices will fall in the future, they will wait to buy goods and services, pushing the velocity of money down, she added. Wood also said the S&P 500 companies that failed to invest enough in the future will become deflationary forces in the economy through what is called creative destruction, the result of disruptive innovations. In this sense, Wood expressed dissatisfaction with companies that borrow money to pay dividends in order to satisfy short-term shareholder desires. She suggested that companies aren't investing enough into the future and are getting by on selling increasingly obsolete goods at a discount, which is causing deflation. Meanwhile, the high inflation observed currently can be attributed to companies playing catch-up with high consumption during the pandemic and over-ordering, probably double and triple ordering a bit more than they really need, resulting in prices falling now that the holiday season is over. In addition to a few prominent economists such as Larry Summers, technology moguls themselves are on the inflation side. Wood's thread was in response to Twitter's founder Jack Dorsey's post, in which he worried that hyperinflation had arrived. Hyperinflation is going to change everything. It's happening, tweeted Dorsey. Wood recalled being in Dorsey's camp during the Federal Reserve's initial response to the financial crisis over a decade ago. In retrospect, she realizes she was wrong because velocity, the rate at which money moves throughout the economy, has declined. In 2008 and 9, when the Fed started quantitative easing, I thought that inflation would take off. I was wrong. Instead, velocity, the rate at which money turns over per year, declined, taking away its inflationary sting. Velocity still is falling. Wood on Wood. In support of her thesis that prices will fall, Wood noted that lumber and iron ores prices have fallen by 50%. Lumber prices soared higher earlier this year due to the demand for housing and shortages caused by industry consolidation following the housing crisis. As one of the most prominent inflationary indicators, Wood defined the high price of oil as an outlier. She noted that the high price is reducing demand, citing supply-side factors like ESG, environmental, social, and governance investments, driving drillers to move to nascent renewables, and banks denying funding to frackers as the main drivers of current prices. On the supply side, ESG mandates have forced energy companies to shift capital spending from mature fossil fuels to nascent renewables. Meanwhile, banks have deprived fracking companies of funding after their near-death experience in 2020, Wood tweeted. The price of West Texas Intermediate crude has pushed above $80 per barrel after settling at around $60 at the beginning of 2020, just before COVID kicked off. Wood argues that the rising price of oil since the lows of last year may be a catalyst that encourages electric vehicle adoption, opening the way for a longer-term decline in oil prices. Over 10% of Wood's Ark Innovation's assets are invested in the electric vehicle maker Tesla. Stocks have rallied 29% over the past year after a slow start and have returned more than 150% on an annualized basis in the past 3 years. If Wood and other deflation proponents are proven right, there is a new investment vehicle to protect against plummeting prices. In the same way that Quadratic Capital Management has attracted billions of dollars to its inflation hedging product, it is launching a sibling that aims to create a product against the polar opposite. The Quadratic Deflation Exchange Traded Fund is using options to protect its investors should the U.S. economy fall into deflation again, as it did during the Great Depression. At a time when all investors are concerned with inflation, the deflation ETF hasn't torn up the track. The ETF has lost 3.6% since beginning in mid-September. The fund's alter ego, the Quadratic Interest Rate Volatility and Inflation Hedge ETF, has gained around 8% last year since its debut in mid-2019, with $2.4 billion in investment inflows. Quadratic's chief investment officer Nancy Davis said in a statement that some investors are concerned the U.S. will experience an environment similar to Japan due to the debt increase and labor shortage. Investors should have tools at their disposal so that they are prepared for a range of economic outcomes and scenarios. The Federal Reserve has described the current inflationary spike as a temporary problem, mainly linked to supply chain snarls caused by the pandemic. Charles Evans, president of the Chicago Federal Reserve, told CNBC in October that he believed prices were elevated but are likely to come down as supply bottlenecks are addressed. If the spell of elevated inflation ends, then Quadratic predicts that deflation will return. This long-anticipated downward slide in prices can be, according to the firm, the result of automation, artificial intelligence, and job offshoring. This is similar to Wood's perspective. She said in a recent talk that innovation has never been in this place before. The Fed and others fear that deflation will bring economic stagnation, as it did in the 1930s, but Wood argues that the deflation she envisions will speed economic growth by increasing productivity dramatically. The last great era of innovation that transformed society took place in the early 1900s, and 3 fundamental factors drove this: automobiles, electricity, and the telephone. She continued by saying that 5 propellants exist today: robotics, DNA sequencing, enhanced energy storage, artificial intelligence, and blockchain technology. Now, if you're a Bitcoin or crypto holder, we have good news for you. In the past, Cathie Wood has explained that investing in the space protects against both inflation and deflation. In other words, you are protected on both ends. The way to look at it is that Bitcoin and crypto are both inflation hedges like gold, and they can also be great investments for the future. By doing this, you are betting on innovation, which is a key tenet of deflation. Now, I'm interested in hearing what you guys think and what you think the most likely outcome will be. Are you in the inflation or deflation camp? Let us know in the comments below. But before ending the video, let's take a look at some of the latest on-chain data pertaining to Bitcoin supply held on exchanges. It is clear that the percentage of Bitcoin held on exchanges is the lowest it has been in 4 years, as traders continue to stack sats and move Bitcoin off of exchanges to cold wallets. This is the main trend we want to watch continue to develop, and it's extremely bullish that there is still plenty of supply emerging from exchanges, despite the price being at an all-time high. And that is all the time we have today, folks. We hope you enjoyed this video. If you have questions, please do feel free to ask them in the comments below. And don't forget to show your support by liking this video and subscribing to our channel and viewing more of our amazing videos. Oh yeah, and one more thing, please do hit that bell icon on your way out to remain updated about all of our future videos. We'll see you next time.